Gina, let me start with you. Explain to me what happened this week, because it was pretty dramatic.
It was a relatively volatile week, particularly after, 6 months of pretty much continuous gains in the equity market. To have a little bit of volatility felt a bit uncomfortable for many investors. But certainly what we did see, I think you accurately captured, David, is the market gyrating around the Delta variant as well as inflation expectations, maybe a little bit of worries carry over from last week, which was more about global central banks, earnings playing a part of the story. But when we really dig into the details, we actually find that companies that reported earnings over the course of the last week have not derived any benefit from those reports. So certainly we are in the midst of a lot of mayhem, I would say, in the market, where investors seem to have kind of lost their footing. I think it's a continuation, frankly, of what's been happening since May, when inflation expectations peaked, when we started to price in peak growth coming over the summer. We lost a lot of leadership on the index, and that really took hold over the course of the last couple of weeks with a lot of on-again, off-again trading.
So, Rupal, you wrote the book, Non-Conventional Investing. Explain the non-conventional approach to what's going on right now, because the conventional wisdom, I think, is we thought we were all going to rush back in, a lot of fears about inflation. Now, I think we're not quite as sure. But what's the non-conventional take on what's happening?
David, thank you for that. And just to correct you, it's non-consensus investing. And I'm known to be a contrarian. So here's, I think, a couple of things to note. One is that equity markets, I think, are paying more attention to the credit market, and rightly so, because the credit markets tend to be much more prescient about, future economic outlook, which ultimately then drives profit outlook for the equities. And the big dichotomy that's occurred in the last couple of weeks in the interest rate environment, where the 10-year bond rate has been correcting against all expectations and against all punditry views, which I'm going to call, are the consensus views that interest rates would rise, they actually did the opposite. They fell. And frankly, inflation has not been higher than the statistics have reported. CPI was over 5%. So you have a record level of negative real rates. And that's putting a bid onto equity markets, which is why every time you see any kind of pullback, they go right back up. And also, I think, to Gina's point, it's also caused a rotation in the market. People were all gung-ho about value making a big comeback. That was the consensus reflation trade. Well, guess what? That's been put to paid with what the interest rates are telling us, that inflation is not likely to get out of control. And that also caused a rotation into growth stocks versus value stocks.
So, Gina, let's come back to you on this. And I take the point, it's non-consensus. I beg your pardon on the non-conventional, non-consensus. But how much of the equity valuation right now is just supported by the interest rates being so terribly low? I mean, a lot of people were saying we're going toward the 2 level on the 10-year yield. And instead, we, as I said, dripped down below 115 basis points. I think we're about 126 now.
Yeah. Well, I think you have to think about equities relative to bonds in a longer term scope. I mean, we got to the point back in May where the equity risk premium relative to bonds had fallen out of its fourth quintile, really for the first time in more than a decade, which said to a lot of investors, hey, look, equities relative to bonds are no longer offering us quite as extreme value as they did. At the same time, inflation expectations started to turn over, and then the story was written from there. Right? By Monday's close, that equity risk premium relative to bonds had finally reached back into the fourth quintile, offering investors an opportunity to buy into a dip in the equity market for the first time in quite a while. And I think we did see that. Now, the question remains as to how much we should be paying for equities globally, how much we should be paying for U.S. equities relative to rest of world equities and the like. But I think that fundamental shift is important to note that, we've been sitting in this fourth quintile for so long, and the relative value of equities in comparison to bonds has been incredibly compelling. But we lost a little bit of that in that really strong rip into May. Now it came back with the sell-off that we've seen, and investors took advantage.
Rupal, one of the things I took away from your book, the non-consensus investing book, was you like to manage risk rather than return. You focus on not losing money as much or more than you do on making money. So in this world, what is the risk we need to avoid as an investor?
Spot on, David. To Gina's point, I think a lot of investors are thinking about putting money to work in equities simply based on a relative valuation trade. I think they should look at absolute value, intrinsic value, not relative. I think both equity and credit markets are quite overvalued. And frankly, instead of just looking at the earnings multiples on stocks, which is what most equity investors do, they should actually start paying attention to the debt multiple. And what I mean by that is there's been a record increase in corporate debt. That is a huge source of risk in the equity markets that the equity markets are not pricing in. If anything, 2020 increased debt levels rather than improve them. And so now we are sitting on a situation where not only is the PE multiple very high, but so is the debt multiple. So when you look at an enterprise value, which takes into account both market cap and debt, compared to earnings before interest and tax, EV to EBIT, we are at record highs in global markets, whether it's international, US. So it's not even a question of, where do you go? It's all of these things are extremely rich. That said, I'm also an optimist, despite being a contrarian. And I think there is a way out because ultimately we need to manage money. We need to generate returns. I think the playbook is going to be that which happened between 2001 and 2010, when we had a lost decade in equity markets in the US. While there was capital depreciation because indices fell, dividends came to the rescue. And if you owned high dividend yielding stocks, which actually paid their dividends, so you got to be careful and make sure they don't have a lot of debt. Otherwise, they can't pay those dividends like happened during COVID. If you own that kind of portfolio, you have hope in making positive total returns on your capital, which is exactly what happened during that decade and the other lost decade in the history of stock markets between 1968 and 1978. Dividends came to the rescue. That's how I would position.
So, Gina, I'd be curious in your views on that. As I understood what Rupal was saying is basically the stocks are fully valued if you look at price-earnings ratio, but we should be looking actually at leverage, something we don't even talk about anymore because when you have interest rates close to zero, who cares? But in fact, there is a lot of debt on the balance sheet of a lot of companies these days.
There is, and certainly the fact that rates are extremely low is supporting the degree of debt that's on corporate balance sheets, without a doubt. If we do have an environment, however, where earnings growth accelerates much faster than the environment we've been over the last 10 years, my view is that's the real contrarian view out there, is no one's anticipating that we're going to actually move into an economic cycle that's much, much faster, powering a free cash flow recovery that's much stronger, which suddenly makes paying back that debt look a lot better. So my question for Rupal would be, in an environment where dividend yield is attractive, you're certainly somewhat dependent on 10-year treasury rates remaining low and economic growth not skyrocketing. Would you change your perspective if you thought that earnings were growing much faster, or would you stick with that same strategy?
I would stick with the same strategy. I would actually, again, take issue with the fact that equity markets are missing or somehow predicting that there's going to be much higher growth rates. The bond markets are predicting the opposite. They are actually saying GDP growth is going to low, inflation is going to remain low, and this is why you're hovering around the 1% mark. This playbook is actually much more similar to Japan. For 10 years, Japan was the first country to do QE, and ultimately QE failed in spurring growth, which, by the way, is exactly what happened in the US. The 10-year economic expansion we had post-QE in 2009 was the longest, but it was also the lowest. It was the most anemic rate of growth. The reason, however, that profit growth still was better is because companies borrowed money to do M&A and to buy back shares. That's financial engineering. If you look at sales growth of companies, it was actually very lackluster. So I would argue that we are living on borrowed times, and Japan is the playbook in terms of what the outlook can be. Ultimately, Japan got out of its funk when corporates delevered their balance sheets. Today, across the world, when I do fundamental research, some of the strongest, in fact, net cash balance sheets are in Japan, and the worst balance sheets are in the Anglo-Saxon world, US and the UK.
Gina, I'm going to give you the quick last word here. Is that right? We're looking at financial engineering rather than real revenue growth?
I think that was a lot of the story of the last cycle. My view is that's not going to be the story of the next cycle. And the reason I say that is because I think a lot of the reason why sales growth was extremely limited over the course of the 10-year cycle that ended in 2019 is because, frankly, the household balance sheet in the U.S. was in complete disrepair following the 2009 crisis.
Yeah. And that's certainly
if
different
we're to look
today.
at where the household balance sheet is today relative to that period,
very different.
It's a completely different perspective.
Very
Households are completely flush with cash
Gina?
and sitting on the lowest debt service ratios in U.S. history.